Hello everyone and welcome to Bald Guy Money. I am Bald Guy, and as many of you know, I have been using cash to buy assets for about 15 years now, maybe a little bit longer than 15 years. And I started due to serious concerns surrounding the debasement of the US dollar and other major global currencies after the 2007, 2008 financial crisis and Great Recession that followed. And these were concerns that only got stronger in 2009 and 2010 when the European sovereign debt crisis kicked off, proving that ideas like modern monetary theory and quantitative easing, which is the printing of money to stimulate economic activity, were becoming the norm. Now, my concerns haven't gone away. In fact, with the whole C-19 inflation fiasco, and the US government accumulating debt at breakneck speed as the Biden administration desperately tries to prop up a stalling economy, we have to ask ourselves, at what point will we see some of these fiat currencies die, and what will be the long-term consequences of them disappearing? Because one of the theories I regularly see kicked around is the idea that we're in for a debt jubilee, which is basically the clearance or forgiveness of all debts, in this case caused by currency collapse because the currency borrowed no longer has any value. Now, something like that isn't necessarily unprecedented, but this idea has created a movement amongst metal stackers, Bitcoin bros, and real estate junkies, a movement within which people are maxing out their debt to purchase real assets with the hope that they will be able to keep the valuable assets without having to actually pay for them once their currency dies. And in this video, I want to explore that idea to show you all what happens in the months and years leading up to a currency collapse, how it will impact your debt, and ultimately answer the question, what happens to your debt when your currency dies? And I really think this video will give you a great idea on the benefits and risks associated with using debt to purchase scarce assets, especially if you don't intend on paying that debt back. Now, just before we get into it, if you're in the USA and want to buy gold or silver at a great price from a dealer you can trust, please check out channel partner Pimbex. They've got gold Australian kangaroos right now on their website as low as 1.9% above spot, which is simply an amazing price. So check out Pimbex.com and this deal. I will leave the link to it in the video description below. And for those of you looking to start a gold and silver IRA, or want to convert your existing IRA to a gold and silver IRA without the high fees and without the predatory pricing spreads, call them at the number on the screen. Just please remember to let them know you came from Bald Guy Money. So, to begin, I want to establish the fact that there is no such thing as an unbacked fiat currency that lasted for a very long time. And at some point, one day, in our lifetimes, or maybe not in our lifetimes, the unbacked US dollar, the unbacked euro, the Australian dollar, the British pound sterling, the Indian rupee, all of these unbacked currencies, any unbacked currency that you can name that is not actually backed by something that has value, will be gone. And this is a fact that is confirmed by history. And before we can answer the question of what happens to debt when that inevitable failure happens, it's important that I quickly cover the steps that lead to the failure, because we've seen failures hundreds, if not thousands of times before, and they all start with the rise of a currency based on trust. Think about how the US dollar was backed by gold following World War II. People trusted the dollar as a result of that backing, and as a result of that trust, the world agreed to make the US dollar the global reserve currency. Now, eventually, that trust is broken. And it doesn't happen all at once like a wife who catches her husband in bed with another woman. It doesn't work that way. What happens is trust in the currency erodes over time. Using our US dollar example, it started with taking the US dollar off of the gold standard in 1971 and has continued with the weaponization and debasement of the US dollar in the following years, leading all the way up to the present day. And slowly, as trust in the currency fades away, it is gradually replaced by something that people perceive as a trustworthy alternative. And this process, in the eyes of the regular person or small business owner, plays out just like this. Starting with high inflation, which leads to people seeking other options to protect the value of the goods they sell and the services they provide. Eventually, things will become priced in that alternative currency, and we are seeing that in countries like Lebanon today, where shops and cafes have prices in US dollars because the Lebanese pound has lost so much value. And at some point, that leads to people refusing to accept the local currency, at which point it is fully replaced by something else, which in the case of the US dollar could be gold, considering how so many central banks are choosing to buy it these days. So, now that we have that established, it's time to talk about debt. And we start from the different types of debt that people are accumulating to buy real assets. And to keep things as simple as possible, I want to focus on two types of loans. The first being loans that usually have variable rates or adjustable interest rates that can change during the lifetime of the loan. These types of loans are usually non-collateralized or unsecured, meaning that you are getting money to spend on whatever you'd like without having to offer anything up as safety for the lender. And for that reason, the rates on these types of loans are higher, and they very often come with adjustable rates because simply these kinds of loans are riskier. On the other hand, you also have fixed rate loans. These are loans that are collateralized or secured by something, meaning there is a specific asset backing the loan up. Think of a mortgage on a house. If you don't pay your mortgage, the bank can take the house back. So for them, it's a little bit of a less risky loan. And that's why loans like this have a lower and steady interest rate during the life of the loan for the most part. Now, the reason I am grouping these loans in this way is because your odds of getting loan relief from inflation or hyperinflation drastically changes depending on whether your loan has an adjustable interest rate or a fixed interest rate. Because as we can see in the case of Turkey, which has experienced high levels of inflation over the last year, interest rates rise relative to inflation, a phenomenon that usually causes individuals and businesses to stop borrowing money and stunts economic growth. But more importantly, for people with variable or adjustable rate loans, it means that as the currency hyperinflates, leading up to the collapse, lenders who can increase interest rates on loans to offset inflation will increase the rates, and your payments will go up in line with inflation as a result. On the flip side of that, for those who have fixed rate loans, which are denominated in a specific currency at a specific interest rate, those people for the most part, and we will cover exceptions in a moment, are protected. And it's the lender that ends up paying the price of high inflation. Just like many banks in the United States are doing right now, as they hold lots of mortgage debt, yielding very little return as they were locked in with low rates on properties that have decreased in value versus the loans given for them, as illustrated by this data here from the St. Louis Federal Reserve. So, now that we have a basic understanding of how a currency collapses and how different types of debt react to that process, what actually happens to your debt when your currency, for example the US dollar, disappears altogether? Well, in the spirit of keeping it simple in a way that can be understood by everyone watching this video, let's start with loans that have adjustable rates. Like credit card loans and many home equity loans also known as HELOCs in the United States, not to be confused with mortgages. What happens to your debt is, as the process of collapse plays out, your rates go higher and higher. And considering the fact that we know wages do not keep pace with inflation because inflation makes everybody poorer, that means your payments will likely be increasing in real terms until the pressure becomes so high that you're forced to declare bankruptcy. Because it's not like lenders aren't going to come after you if you stop paying your loan. They will come after you, even if the currency is hyperinflating. In fact, they might especially come after you if the currency is hyperinflating. At which point, it is possible that some of your personal assets, like your car or your home, can be taken and sold by your creditors to get the money back. And overall, it's a very stressful process that's not worth a few gold coins on your credit card because some YouTuber told you that the dollar was going to disappear by February 1st. Now, when it comes to collateralized loans, like a mortgage, which has something of concrete value backing it up, remember, most of these loans are locked in at fixed rates. In fact, in the USA, approximately 90% of home loans are at fixed rates today. As hyperinflation takes off, the actual value of what you have to pay back goes down in real terms. Because with a fixed rate loan in a hyperinflationary environment, the fixed rate cannot be adjusted to reflect higher rates of inflation. At the same time, as this chart clearly illustrates, nominal wages increase with inflation. And even if they don't fully keep up with inflation, it doesn't matter, because the rise in your income will be much greater than the fixed interest rate payments. Meaning, if your interest rate was 7% on a 20-year fixed rate loan for $100,000, and inflation is around, let's say, 57%, and you saw a corresponding 57% increase in your wages, you can see here in this example, for a person making $50,000 a year, their entire mortgage goes from being 4.3 times their annual salary to a mere 2.75 times their annual salary once salary increases to reflect higher levels of inflation, which means the original loan just became about 36% cheaper for you versus when you took the loan. But before you call the bank to get a fixed rate loan that you're going to YOLO on gold coins and crypto, keep these real world examples in mind. The first one being when the European Union switched over to the shared currency, the euro, in a process that basically took place over 13 years between 1999 and 2012. But to make a long story short, when the euro was launched in 1999, European banks converted balances and debt into euros on a fixed exchange rate, and those rates are shown here on the screen. Meaning that people who intended to benefit from fixed rate loans thanks to inflation saw their debt and salaries converted into euros, which often left their debt at the same real value as when they took it, as they saw euro currency inflation eat away at their real earnings. And if you experienced that in the Eurozone, leave me a comment and let me know how that impacted you personally. I would love to see some examples on this, because what this ultimately did is this didn't make debts easier to pay. It actually made them harder to pay in many circumstances. Now, another good example I can give is what is happening in Egypt right now to many people who purchased properties on a payment schedule in Egyptian pounds from a foreign developer. And mind you, this is simply according to what I am hearing coming from sources in the country, but due to a massive devaluation of the Egyptian pound, which has driven numerous Egyptians to gold and other safe haven assets, some people are being asked to make their property payments in US dollars, as some foreign developers are no longer accepting the Egyptian pound. So, all of this is to say, yes, our fiat currencies are devaluing, and it's not out of the realm of possibility that some of our fiat currencies, ones that we're using today, will fail in our lifetimes. But if you're borrowing money to purchase hard assets in the hope that you're not going to have to pay that debt back, I'm saying don't count on it. Bankers, lenders, and the financial industry at large have politicians all around the world in their back pockets, and although you may be able to squeak out a win or two here and there, like many who locked in low fixed rate mortgages during C-19 have, the odds are generally against you, especially when it comes to things like credit card debt, which is why I never encourage anyone to buy gold, silver, or Bitcoin on a credit card. That type of behavior is the path to financial pain, not the path to financial freedom. So be careful when using debt as leverage, and if you're using it to invest, just make sure your returns are high enough to service the debt in normal conditions, like if you're buying a rental property. Do not take a loan built on the assumption that the value of the loan will disappear overnight. Believe me when I say that the financial industry learned many lessons from the collapse of the German mark in the Weimar Republic, and they're not likely going to repeat them in quite the same way. And for that reason, the odds are heavily stacked against you in a financial game of chicken. With that said, that's it for this video. Sorry I don't have time to cover the viewer question today for this video, but I will do a viewer question in a community post very soon on YouTube. So if you have any questions for me, be sure to leave them in the comments below. I read all the comments, and usually, this video is just an exception, but I usually answer a viewer question in every one of my videos. So please do not be discouraged. Leave me a comment below. And remember, if you want more Bald Guy content, take a look at my Patreon. Link to join is in the description and pinned comment. So until the next time we see each other, everyone, take care of yourselves and take care of each other. Goodbye.